I think we can slowly get started. Nilesh and Zeeshan, thank you so much for being here with us. I'll make some quick introductions and introduce who Nilesh and Zeeshan are. Mr. Nilesh Asher, he's a tax partner at KPMG here in the UAE. Nilesh has over 25 years of experience with the big four internationals and M&A tax advisory services, advising clients across the region and the Middle East for over 25 years, including India, the UK, and Europe. He serves as the lead tax partner on a number of key accounts and advised a range of clients on issues to do with tax, including international and corporate tax, transfer pricing, VAT, custom duties, and global mobility tax issues. Nilesh, it's a pleasure to have you with us, and thank you so much for taking the time.
Thank you, Lorenzo. Thanks for the invitation to speak on this platform.
Great, and we also have Zeeshan Toor, who is the General Manager of Creative Zone Tax and Accounting. He's been the GM of this body for over 4 years now. He's an Associated Certified Chartered Accountant, ACCA, CMA, and UAE CA. Zeeshan has a diverse experience and keen insights towards accounting, bookkeeping, and other services, and he's been leading the Creative Zone Tax and Accounting division, where we advise clients on tax and accounting related matters here in the UAE. So for today, Nilesh, I understand you have a presentation ready for us. I think we're ready to go through this. You have a few slides. What I also can advise the attendees is you feel free to send us your questions as we go along, and we're going to try to be reading some of those questions as Nilesh goes through this presentation, and also Zeeshan is going to be picking up on some of these topics, and we're going to be trying to raise some of those questions as we go along in the presentation. So Nilesh, it's all yours.
Thank you, Lorenzo. And obviously, while I run through the slides, I won't be able to see the questions. So feel free to interrupt as you see them, Lorenzo. I'm happy to address any questions as we go along. So thank you once again, Lorenzo, for the opportunity. Good afternoon, good evening, good morning, everyone, depending on where you're listening in from. I think Lorenzo probably gave a little bit of my age away with my 25 years experience that he was talking about, but I moved to Dubai in 2012 with KPMG as a partner, and I can say that the day has finally arrived when corporate income tax or corporate tax is finally looking to get introduced here. So now I think this is a very critical moment in UAE's fiscal policy development. What I do have on this presentation is to talk through some of the highlights of the announcements that have been made on corporate tax, and then look through some of the issues that are potentially likely to apply to businesses operating in the UAE, and notably the Freezone businesses, which I'm sure will have questions around the applicability to their activities. We don't have the law yet. So that's expected in the middle of the year, but really the backdrop to the introduction of corporate tax in the UAE has been the pressure that OECD, that UAE has had, and along with other countries on being a BEPS inclusive framework member of the OECD. UAE has committed and endorsed the global minimum tax proposals, which has been the backdrop to the introduction. Now, under those proposals, that applies to certain large groups. Those large groups operating in multiple jurisdictions essentially have to pay a 15% minimum corporate tax on their profits at a jurisdictional level. So if UAE did not have a corporate tax legislation in place, any businesses, whether headquartered in the UAE or set up in the UAE, that are within the scope of these global proposals would be subject to a 15% tax, even on the UAE profits even if UAE did not have a corporate tax law. And obviously, as part of the inclusive framework member, UAE has committed to the OECD to support these global proposals. And it also is a significant step in UAE's own development and advancement as an international and a global jurisdiction to do business. But in that backdrop, we've had on the 31st of January, the announcement has been made to introduce corporate tax effective financial years beginning on or after the 1st of June 2023. What we do have at the moment is an announcement with about 50 odd FAQs, which sets out the policy direction that will be adopted in the corporate tax law when it is introduced. I do want to note that we do not have the tax law yet. The actual corporate tax law is expected in the middle of the year, and therefore more details about the legislation and the potential issues that we will discuss will hopefully get clarified once the law gets announced. But what we do have in terms of the announcement is that the corporate tax law will come into effect on financial years beginning on or after 1st of June 2023, and therefore for a business that has a December year end, the first applicability is actually not until 1st of January 2024. And obviously, if you've got a year end in the middle of the year, if it's 1st of July, it's when your financial year begins, and obviously the first corporate tax period for you is 1st of July 2023. So you do need to look at the applicable effective date for your business depending on what your financial year end is. In terms of the rates, the headline rate is 9%, for corporate tax purposes, with a 0% rate for small businesses that have a taxable income of up to 375,000 dirhams, which is $100,000 and thereabouts, and anything over that is 9%. For some of the large groups where the global turnover of the groups is in excess of 750 million euros that are within the scope of the global minimum tax proposals, which UAE has endorsed, the rate is a different rate, which is possibly 15%. So 15% is not stated in the announcement that the UAE has made, but we do know that under the global minimum tax proposals, 15% is the rate that has been globally agreed by the OECD along with the G20 and the OECD member countries. So that 15% rate is likely to apply to a UAE subsidiary of a foreign parent that is otherwise within the scope of the global minimum tax rules. But if not, you are then in the 9% rate if your income is over 375,000 dirhams. In terms of scope of the corporate tax, essentially it's your trade license that determines whether or not you are liable for corporate tax or not. So it's essentially all UAE businesses, whether set up as branches of foreign companies, whether set up as companies, whether set up as partnerships or trusts. Essentially, if you have a trade license, or if you operate under a trade or a commercial license, all income earned by those under that license is subject to corporation tax. As far as individuals are concerned, individuals like you and me that may earn any employment income or rental income from properties, as long as we don't need a commercial license to earn that income, there is no personal tax that applies to those streams of income, which obviously will be helpful news for everyone. As far as foreign companies are concerned, foreign companies will only be subject to tax in the UAE if they conduct a trade or business in the UAE on a regular basis. So any passive income earned by foreign companies, and we have an example of this in this presentation, any passive income earned by foreign businesses, if of the nature of dividends, capital gains, interest, royalties, etc., should not be subject to tax. There is an exclusion for businesses engaged in the oil and gas sector that are currently subject already to the emirate level taxation, which is at a much higher rate. This is only for oil and gas extraction activities and not all oil and gas activities. And banks are in scope. So today, foreign banks already pay corporate tax at an emirate level at a 20% tax rate. So now you will have both foreign and local banks in scope of these rules, but the interplay between the current foreign bank decrees and the corporate tax law, which will be at a federal level, is to be announced, and we await more communication on the current emirate level decree. Free zones, big, key topic, I'm sure relevant for most businesses and most of you on this call, and we'll talk about it in a bit more detail. But essentially, the UAE has committed to honor the free zone exemption that businesses currently enjoy. So foreign businesses will continue to be exempt or subject to a 0% tax rate under the tax law, provided two key conditions are satisfied. One is that they comply with all the regulatory requirements, and two, they conduct business only if they do not conduct business with mainland UAE. And we'll talk on this in a bit more detail. The exemption is not automatic, so all free zone companies will need to register for corporate tax and file corporate tax returns in order to claim the exemption. And as you can imagine, we would expect more scrutiny and audit on those free zone companies on the corporate tax returns, particularly if they're claiming a tax exemption under the tax law. We do hopefully expect additional guidance on what is meant by conducting business with mainland UAE. And this is obviously an issue because when free zone companies were set up in the past, when there was no corporate tax regime, the primary condition of setting up business in the free zone was not really a corporate tax exemption, because even on mainland there was no corporate tax that applied, but it was essentially the ability to set up 100% foreign-owned company, which there were limitations on mainland, and those limitations, as many of you may be aware, have also now been lifted. What has not been announced but is a potential issue is what happens to treaty claim, double tax treaty claim, where there are free zone companies that intend to continue to enjoy the exemption under the free zone. Because if they are now exempt from corporate tax under the UAE corporate tax regime, while mainland businesses are subject to tax, the question is, will you still continue to enjoy the tax treaty exemption on the basis that you are liable to tax in the UAE, which is what most double tax treaties contain. But that's something to watch out for in the future. There is exemption from dividends and capital gains earned from qualifying shareholdings. And we don't have the definition yet of what is a qualifying shareholding, but we would expect this to be in line with the provisions of the participation exemption regime that applies in other parts of the world. So essentially, if you earn dividends and gains from shareholdings that exceed a certain percentage, and or there's a minimum holding period and some other conditions are satisfied, then those dividends and gains should be exempt from corporate tax. And equally, foreign investors' income and from dividends and gains, all passive income is again exempt. There will be tax grouping provisions. So any intra-group transactions and reorganizations, so transfers of assets and liabilities and expenses and income between entities that are eligible to form a corporate tax group will be entitled to an exemption or will be disregarded for corporate tax purposes. Equally, losses that may be incurred by one entity may be eligible to be offset against the profits of another entity that form part of the same corporate tax group. And equally, there will be a relief that will be available in terms of one tax return to be filed for entities that form part of the tax group. And importantly, as far as losses are concerned, any losses that you incur will be eligible to be offset against taxable profits in the future, with the one announcement that says that these losses will only be eligible for periods starting the tax year. So it's only losses incurred with the corporate tax effective date that will be eligible to be offset. So any current losses that you may already incur in the business will not be eligible to be carried forward and offset against profits in the tax year, in the first tax year when tax law goes into effect. But within a tax group, you will be eligible to offset tax losses of one group company against profits of another group company. In terms of tax payments and computation, we don't have the computation mechanism yet, but it will essentially be your financial statements that you will start off with, your profit and loss as per your profit as per your P&L, and we expect any adjustments to get to your tax computation to be fairly limited, and that's helpful. So it's essentially the adjustments and your accounting principles on income and expenses that will likely drive your computation for tax purposes. There is no withholding tax, helpfully, on domestic or cross-border payments. So any payments made by UAE entities to other UAE entities or to foreign companies will not be subject to any withholding tax. And as far as UAE businesses are concerned, there is no advance tax or self-assessment taxes to be paid. There's only one tax return that will be due and filed at the end of the year. In line with other tax jurisdictions, any foreign taxes that you suffer, a UAE business, if it suffers, for example, any foreign withholding tax on payments that it may earn, will be eligible as a tax credit against the UAE tax liability. Of course, we would expect that tax credit only to be limited to the UAE corporate tax liability at 9 or 15%. So if you've suffered a 20% withholding tax overseas, you may be able to take a credit only for 9 or 15%, depending on which bracket you fall under. There will be formal transfer pricing provisions that will be introduced in the law based on OECD principles. So any intra-group charges, any intra-group transactions, any intra-group funding, which currently are not subject to any transfer pricing rules, because obviously there is no corporate tax in the UAE at the moment, will now need to be priced on an arm's length basis. And this is where you will need to look at whether the related party transactions are within the same tax group or are outside the tax group, because the requirements may well be different for entities that form a tax group and those that do not from a transfer pricing perspective. In terms of administration, it's the FTA. Expectedly, it's the FTA that will be responsible for the administration and collection and enforcement of the tax law, and some of the detailed compliance obligations and penalties will be announced when the law is announced, but also will draw some reference from the tax procedures law, which has been in place since 2017. But some of the specific penalties, we expect them to be announced as part of the tax law in the middle of the year. So coming to free zones, as you all know, there is. Let's see if I can. Yeah. So free zones. This will be relevant for most businesses. So if you've got a company in a free zone, the exemption will be honored. There are two key conditions for the free zone exemption to apply. The first is that the free zone company complies with all of the regulatory requirements, and we would expect this to include references to having a valid trade license, making sure that the trade licenses are renewed on a timely basis. Any information that is required to be submitted to the free zone authorities are submitted on time and in line with the regulations. And then the second condition is that a free zone company must not conduct business with Mainland. Now, it says it must not conduct business with Mainland and not on Mainland. And while this term is not defined, we do expect the law to provide more clarity on what is meant by doing business with Mainland. So if you have a free zone company that sells to a Mainland customer or provides services to a Mainland customer, even though the services are provided from within the free zone or the sales are made from within the free zone, does that mean that you are conducting business with Mainland? Or does that negate or challenge the exemption? So as an example, which you can see on the chart on the right, if you have free zone company 1, which deals in, which is based in free zone A, if the free zone company 1 only, and if I look at the left side of the structure, if it only conducts business with free zone company 2 within the same free zone, obviously that income is likely to be exempt. If that free zone company 1 deals with the rest of the world and earns income from the rest of the world, again, the income should be exempt or subject to 0% rate. If free zone company 1 deals with another free zone company in another free zone, so in free zone B, then the question is, does the exemption, you continue to enjoy the exemption? Possibly yes, because the reference is to conducting business with mainland, and in this case, you're still conducting business in the free zone. Now, when you then go down to the mainland, if you then have the same free zone company that's also conducting business with mainland, and we need to have more clarity on what that means. Clearly, the mainland income is taxable. The question then is, what happens to your exemption for income that you generate from free zone company 2 and from the rest of the world? So the question really is, will there be a proportionate denial of your free zone exemption to the extent there is income from mainland business? Or is it an all or nothing denial of exemption? So even if you have, let's say, a dirham of income from mainland business, will that challenge and deny and negate the entire free zone exemption for all activities conducted by the free zone company? We certainly hope it's a proportionate denial, but clearly we need to wait to see what the law says, and it may well be an all or nothing provision. There are obviously, various elements to this structure, which is you've got a number of companies in the free zone that also have branches on mainland. And what happens to those branches of free zone companies, because at the end of the day, the legal entity is a free zone company. And if it operates through a branch on mainland as an entity, it's still one free zone entity. And would that again deny the exemption? So lots of questions more than answers, but clearly, companies that are in free zones must look at their operating structure and see whether there is, what the impact of these conditions are likely to be, and therefore will the free zone exemptions continue? Or
would this, Nilesh, sorry, just to butt in here quickly, wouldn't this fall similarly with how VAT is actioned, in the sense when free zone companies, or even they are invoicing clients internationally, they're not invoicing with a tax invoice? Could this be a similar structure for the income tax?
Yeah, I think there are two things with VAT, and I put a section on VAT, I think, in this slide deck, which throws up some interesting nuances. But as far as VAT is concerned, because VAT, as you know, Lorenzo, is a tax on transactions. We have, and it's a tax on transaction on goods and services. The concept of designated zones is there for VAT purposes, and that applies to supplies made either within the designated zone or outside the designated zone. But because corporate tax applies at an entity level on the profits of the business, I would expect that, I don't think there will be a similar category of designated zones for corporate tax purposes. I think that will be largely for free zones, but we need to see how the law develops in that space. So if there is a supply between or within the designated zone, which is outside the scope of VAT, it may, and as you know, VAT is an indirect tax that ultimately you and I bear. Even a business that's in a designated zone, but that supplies goods to a customer on mainland, it is required to charge VAT, which is then obviously ultimately passed on. But I don't see that, I don't think there will be a distinction between VAT and VAT zones and corporate tax zones.
What about those cases for companies in the free zones that do know they are going to be engaging with other entities or individuals in the mainland, and they know that they're not going to be, or they're going to be below the 375,000 dirham threshold? Would they still be requiring to sort of file for corporate tax, knowing that what they do with the mainland is below and the rest is done with other free zone entities?
Yeah, so I think if the income of the free zone is below 375,000 dirhams, then doesn't matter whether that income is generated from mainland or free zone or foreign business. of foreign customers. If the income is below 375,000 dirhams, the tax is at 0%. But I would still expect those companies to be required to register for corporate tax and to file a corporate tax return, because ultimately that 375,000 dirham number may still well be audited by the FTA to confirm that the eligibility applies at 0%.
Right. I know you have a few more slides coming through. Maybe Zeeshan, is there something that you would like to share from what we've discussed so far? Maybe I might have a couple of other questions from the audience to bring up, and then we'll continue with the rest of the slides. Nilesh, is that okay?
Yeah, sure. Yeah.
Zeeshan, from your point of view and the experience so far of the questions that we're getting from our own clients, what could be your take on this so far?
Yeah, so yes, Lorenzo, we've already seen clients asking about questions regarding free zones, where they want to establish how to do business, and they're already worried about all these topics regarding corporate tax coming into place, and they want to, especially when they're establishing businesses, to see how to establish a company and structure it in a way so that they can utilize that 375 at a 0% mark, 0% tax. So that's one of the areas that clients are focusing on and they're questioning on, and they want to do it in the right way. Everyone knows that tax is coming into place and everyone wants to comply with these regulations, and don't fall foul of these, because now the penalties start huge there, and we still need to know about the regulations regarding corporate tax, how these will pan out.
Yeah, some good points. I think it's correct. I think this really shifts a little bit the sort of the mindset when people are looking to set up. In the past, people were not concerned about whether they're setting up in the mainland or in the free zone. Now they're going to be a little bit more sort of organizing themselves from the start and thinking what's more efficient from a tax point of view, right, Nilesh?
Yeah, absolutely. I think there are two categories of businesses: those that are below the global minimum tax threshold. Clearly, there is clearly a lot to think about in terms of the structure that they put in place for the UAE, and if while the free zone exemption should continue, they need to structure their operations in a manner that strictly falls within the criteria of the free zone exemption. Whereas in the past, this was really an issue that you didn't really have to think about too much from a corporate tax standpoint. Certainly from a VAT standpoint, you had to, but you didn't need to think about it as much from a corporate tax standpoint.
Yeah.
And a related issue actually is, the last bullet point on my slide here, which is on tax grouping. So if you have companies in both free zones as well as mainland, the question is, can you form a tax group between a free zone and a non-free zone company? Now, we think that if the free zone company is entitled to the exemption, then it is unlikely that it will be eligible to form a tax group with a mainland company. But but you may well see provisions, and we need to wait for the law to confirm this, whether the free zone company can actually elect to form part of the corporate tax regime and pay taxes. Now, you might say, why would a company elect to pay taxes? And the reason for that could be if your free zone company is loss-making, for example, and it's likely to be loss-making for a few years, you might actually look to elect for the free zone company to be part of the tax regime, and then form a tax group between the free zone company and a mainland company that may be profitable from its UAE business, so that you can use the losses of the free zone company and offset it against the profits of the mainland company, and therefore reduce your overall tax liability. So there's some level of legitimate planning that may be possible depending on how you conduct business in the UAE, both within the UAE and outside the UAE in the region for your activities.
What about those companies that are holding entities in free zones and are owners of businesses operating in the mainland?
So that's a nice, perfect question for my next slide, Lorenzo. So you have exemptions, and sorry, the formatting on the chart may have gone slightly awry on this. Apologies for that. But there is an exemption for passive income earned by businesses, and the UAE is quite keen to ensure that its competitiveness as a holding jurisdiction continues. And essentially, what the announcement says is that any dividends and capital gains from qualifying shareholding will be exempt from corporate tax. While qualifying shareholding is not defined, we expect that there will be a certain minimum shareholding, maybe 5 or 10%, and a certain minimum holding period, maybe 1 to 2 years, that may qualify as that may meet the requirements of a qualifying shareholding. And if you've got in this example, if you've got a parent company, regardless of whether that parent company is in the free zone or outside the free zone, but essentially, if a company in the UAE earns income from qualifying shareholding, which is in the nature of dividends and gains, then that will be exempt. But if it's non-qualifying, it will be taxable. Now, if, let's say in this example, subsidiary 1 is situated outside the UAE, in which case, it's a non-qualifying, and if it's a non-qualifying shareholding, obviously the income would be taxable in the hands of the parent company. But if the parent company is situated in a free zone, let's say the IFC, and subsidiary 1 is situated in Egypt, as an example, then essentially the free zone company, the parent company, can enjoy possibly the free zone exemption and claim that the dividends and gains from subsidiary 1 is exempt from tax on the basis that it's all foreign sourced income and not UAE sourced. So depending on what the shareholding, where the shareholding is, what's the nature of shareholding and the period of shareholding, you may be able to enjoy the exemption on dividends and gains from a holding structure in the UAE. And equally, just to extend this example, if you've got foreign companies that own shares in UAE holding companies, then any income that they earn in nature of dividends, gains, or interest from the UAE shareholding will be exempt from UAE tax, whether withholding or otherwise. Of course, the ultimate parent company may be subject to tax in its own jurisdiction. So I think what this really shows is that UAE, the announcements are, to consider UAE as a competitive holding jurisdiction, an attractive holding jurisdiction, and to compete with the likes of the Luxembourgs and the Netherlands and the Singapores of the world, to be an attractive holding company jurisdiction. So that's a step in the right direction. I would feel very, very progressive. I think, for groups that are below the threshold, this may not be as relevant. But if you are a company in the UAE that is part of a large multinational group with consolidated turnover in excess of 15%, then you are in scope of these global minimum tax rules, which essentially require you to compute your effective tax rate for the UAE and pay tax at a minimum level of 15%. So in this case, if you have a mainland and a free zone companies, where the mainland company is subject to 15% tax and the free zone company is subject to 0% tax, on a consolidated basis, even though the free zone company under the UAE corporate tax regime does not pay any tax, but the consolidated ETR of the mainland company is of the UAE as a jurisdiction is 7.5% in this example. In such a case, there would still be a top-up tax that would be collected either in the UAE or in the parent jurisdiction to the extent of 7.5%. So if you're part of a large multinational group, the free zone exemption may in some sense be irrelevant, because you would end up paying the 15% corporate tax regardless of the free zone exemption, whether in the UAE under the global minimum tax rules that UAE may incorporate. And if UAE does not incorporate that, whether in 2023 or 2024, it may get picked up and taxed in your parent jurisdiction, and therefore may be relevant. So just something for businesses to think about. If you're part of a large group the fact that you're in a free zone does not mean that you are outside the scope of these global minimum tax rules, and that would still be relevant for from a cash tax cost perspective, as you may end up paying the tax regardless of the free zone exemption.
These are obviously branches of companies from outside set up in free zones, right?
Well, actually, they could apply even to free zone companies. If you are a subsidiary in a free zone, let's say you've got a parent in the UK or in Singapore, and you've got a subsidiary in a free zone that is entitled to an exemption. Therefore, your jurisdictional ETR will be 0, right? But under these global minimum tax rules, essentially, the free zone company ought to pay a 15% tax at the minimum in the UAE or for the UAE or on the UAE's profits. So regardless of the free zone exemption, 15% tax will have to be paid in respect of the profits of the free zone company, whether in the UAE under, without getting too technical, under under a domestic top-up tax regime, which is UAE will essentially top up the tax to 15% for that free zone company, and it has to be paid to the UAE tax authorities, perhaps by the free zone company itself, or it may get picked up at the level of the parent company in either UK or Singapore, in my example, and get taxed in that jurisdiction in respect of the UAE's profits. So the UAE profits could well get taxed, not necessarily either in the UAE or in Singapore or UK, wherever the parent is located.
But previously we were saying that royalties and dividends were non-taxable in this case. So if we are sending dividends and royalties back to the mother company, how would this work out?
So if dividends are paid out, royalties are paid out by the UAE company to its parent, obviously there's no withholding tax on those dividends and royalties. But those dividends and royalties, when earned by the parent company, would be subject to tax. And without going into the technicalities, as the rules are quite complex, but in theory, that income will be subject to tax in the hands of the parent jurisdiction, either at the domestic tax rate, and that could be, for example, 17% in Singapore, but Singapore would enjoy the exemption may enjoy the exemption for dividends. But in the UK, for example, if the dividends were paid to the UK does not apply a tax on any foreign sourced dividend. So in that case, this income is not subject to tax in the UAE or in the UK. But then we need to see whether those dividends are also exempt from tax under the global tax rule. So the point, Lorenzo, it can get quite complex and technical. The point really is that if you're within the scope of the global minimum tax rules, then the free zone exemption may be academic in some sense under the UAE corporate tax regime, as you may be picked up for tax under some other provision in either the UAE or another jurisdiction. In any case, but if you're below the threshold, clearly the free zone exemption is attractive and will continue to be attractive.
Right.
Just conscious of time, very quickly, we talked about transfer pricing. So today you've got situations where related party transactions between UAE groups and UAE groups dealing with their foreign parents or foreign subsidiaries or foreign group entities are, because there was no tax in the UAE, we were less concerned whether those charges were on an arm's length basis or not. So if there were services provided by a UAE entity to its foreign parent, there was no requirement for those services to be on an arm's length basis from a UAE standpoint. So you could either cross-charge at cost or not cross-charge to your foreign group entity. And because the foreign group entity would have enjoyed a tax reduction, the tax authorities there would have been less concerned whether the charge is excessive or not. But now with corporate tax coming in, any services provided by UAE companies to its foreign group companies, any funding provided by UAE companies to its foreign group companies, any support provided, management services, supplies of goods and services, etc., will need to be on an arm's length basis, based on transfer pricing provisions and benchmarking based on OECD principles. And what this will also require is this will increase also the compliance burden for UAE businesses, because there will likely be transfer pricing documentation that you will need to maintain for the related party transactions that UAE entities enter into, and whether that's benchmarking reports or transfer pricing policies, or whether it's local files, or whether it's a transfer pricing declaration that needs to be submitted along with the tax return, like how you have in Saudi and Saudi Arabia and in Qatar. Hopefully the law will clarify what all are the administrative and compliance obligations around that. But clearly more to think about in terms of related party transactions between UAE and non-UAE entities, and even perhaps domestic entities. So even transactions between two UAE entities may well be in scope of transfer pricing provisions that may be announced. I think this is probably my last slide, and then we can open it up to question. I think there's we've been living in the UAE under a VAT regime now for over 3 years. A number of VAT issues that will come up when you look at it from when you look at corporate tax. So starting from the top left, if you're looking or considering any group restructuring to mitigate the impact of corporate tax, so whether you're looking to move businesses into free zones or split free zone businesses or anything related, do think about what the VAT implications could be, because any transfer of businesses or assets may have VAT implications. There will also be the difference between you today have VAT groups under the VAT legislation, and you will have a corporate tax grouping possibility under the corporate tax law. It is likely that the threshold for forming a VAT group may be different to what you will have for a corporate tax group, where the shareholding threshold is likely to be a lot higher than what you have for VAT. So it's possible that you may have, if you have multiple entities in the UAE, you may have certain entities that are eligible to form a VAT group, but are not eligible to form a corporate tax group, and vice versa. And therefore, where you've got transactions between a VAT group that is obviously disregarded for VAT, but if those transactions are between entities that are not part of a corporate tax group, then you may have to apply an arm's length margin to those transactions from a corporate tax perspective, and vice versa, to the extent you've got transactions between two corporate tax group entities that are not part of a VAT group. Then while those transactions are disregarded from a corporate tax perspective, but obviously you need to account for it from a VAT standpoint. So there's certain nuances that you need to be mindful of when you look at any restructuring. We also have the issue around place of establishment versus permanent establishment. So foreign companies are subject to register or liable to register for VAT if they have a place of establishment in the in the UAE, and that's based on the VAT law. But we have, under corporate tax law, there's likely to be a wider tax concept known as permanent establishment, and that can be somewhat wider in its application than a place of establishment. So the issue really is that you may have a place of establishment but not a permanent establishment, and vice versa. And therefore, you may have situations where you may have to register for VAT but not corporate tax. You have to register for corporate tax and not VAT. And sometimes those concepts can overlap as well. In terms of deductions, you'll obviously likely have certain deductions that are eligible for corporate tax purposes. Equally, there are deductible versus non-deductible expenses for VAT that you are eligible for under the VAT law, and you do need to have records bifurcating these deductions under the two separate legislations, because corporate tax deductions which you are eligible for may or may not be eligible for a VAT input credit, and vice versa. The other interesting bit that comes out is on deemed supplies. So there's a concept of deemed supplies for VAT. So if there were any intra-group transactions, for example, that were not carried out on an arm's length basis, and there was no cross charges done because there was no need to from a UAE corporate tax perspective. And if under the proposed corporate tax legislation, you do need to price those transactions on an arm's length basis and therefore start charging for those services, the question is, does this create a deemed supply issue for VAT for the past? And whether you ought to have accounted for VAT on deemed supplies for prior years if you start charging for those supplies now under the UAE corporate tax provisions. That's something for for businesses to think about. And then you've got transfer pricing impact on on customs valuation. So any imports into the UAE, obviously UAE businesses will need to ensure that those imports now we're on an arm's length basis. And if there's any adjustment to the import values on account of transfer pricing adjustments, that obviously has a knock-on effect from a customs duty payment and an import VAT perspective. So as you can see, there are a number of implications that corporate tax has on VAT and customs and so on. And then the final point really is that we've got a number of compliances that have cropped up in the UAE in the last 3 or 4 years. You've got filings that you do with the FTA for ESR, for VAT, for customs with the customs authorities, and obviously FTA has access to that. You will then have filings to be done under corporate tax and possibly under the global minimum tax rules in the future. The point really here is that there's a number of information that will be submitted to the authorities, and it's really important that there is consistency between what is submitted under one legislation. Obviously, to the extent the legislations are different, there can be inconsistencies. But in terms of the data, be mindful that what you submit for corporate tax is also not inconsistent with the data that you may have submitted for VAT or for ESR or for customs purposes. So really, the message here is that corporate tax is, while businesses will be impacted by corporate tax, it's really looking at what could be the impact of corporate tax on this, on some of the other taxes and legislations that businesses are already subject or liable to. And really, I think what we think businesses need to do is really start thinking about your structure and entities in the UAE. Where are they located? How many entities do you have? Do you have too many entities for the required for the purpose of the business? Because if you do, then unless you tax group them, you'll have a tax filing obligation at every entity level. Look at your intercompany transactions and operating model to see if there are any changes to be made. Look at some scenario-based analysis for corporate tax exposure. So whether you're in the free zone, not in the free zone, whether you're part of the multinational group that is subject to the global minimum tax rules, what happens if, under the computations between corporate tax and the global minimum tax rules? Do you have internal controls and governance in place for extracting the data and monitoring and filing the data for corporate tax purposes versus what you may already have for VAT and excise and other taxes? And really look at the impact corporate tax may have on your accounting, because you'll start creating deferred tax assets and liabilities for temporary differences that will reverse once the corporate tax law is in effect. We talked about the related impact on indirect taxes and VAT, and then obviously, do you have the right technology to both extract data for corporate tax filing purposes, but also to monitor all your tax compliances, which are just increasing in the region with corporate tax coming in. So that's really what I had, Lorenzo, as part of this session. I think we've got a few more minutes for questions if we have any coming through.
Yeah, definitely. No, thank you so much for that, Nilesh. There was a lot of very good information and a lot of good details. We do have quite a few good questions. And I had one in particular that was a bit sort of related and covered in your last slide, but maybe to sum it up, how can, business owners and many of the people watching this right now could start getting ready? What would you be your first few tips on how is it that they should start getting organized for getting themselves organized for this? And the second part of the question will be, when can we expect the full details of this new introduced corporate law to be introduced formally? Yeah,
so I'll take the second one first because that's a short answer. The announcement says the middle of 2022 is when we expect the law. I just think, given in the region how July and August is pretty much holiday season here, I would expect the law to be announced before the holiday season starts, so perhaps end of June, early July, during the month of June or thereabouts. And in terms of where to get started, I think it really boils down to going back to the basics of seeing how many entities you've got in the UAE, what is the business and the activities performed by those entities, what's the profitability level at the entity level, what's the forecast that you have for businesses that are based in the UAE, and see whether there are any any accounting adjustments, what your accounting policies are, do you have financial statements for entities or not. So it's really taking stock of your current entities in the UAE, the current activities, and the profitability levels at those entities, and based on the information we know, explore whether there are any avenues to legitimately optimize and plan for taxes, for the corporate tax introduction. Knowing very well that the rate in the UAE is at 9%, which is the lowest in the, it's very competitive. It's one of the lowest corporate tax rates in the world where there is corporate tax regime. And other than Bahrain, which yet does not have a corporate tax law, it's the lowest in the GCC, in the Middle East region. And I would not recommend that businesses start looking at seeing ways in which to evade or avoid taxes, because it's fairly competitive as a tax regime. So I think to the extent you can legitimately plan for the avenues that the law is likely to have around exemptions and exclusions, there's probably some helpful thinking that can go in looking at the current structure, current operations, and perhaps the future outlook in terms of forecasts on profits and activities.
Zeeshan, from your side, what would this be changing, accounting, bookkeeping practices of SMEs? What can we recommend on how is it that SMEs and a lot of our own clients should be organizing themselves for this?
Yes, so because corporate tax is not coming in, so every entity needs to look at the resources they have. Like Nilesh said, first, it's a planning-wise structure that needs to be put in place, but also you need to look at your finance department, because you need to now have competent people. You can't just have for example, your receptionist do some entries and be okay with it, creating those Excel. You need to have a proper system in place, because these accounting records can be checked from a different point of view regarding VAT, regarding ESR, regarding corporate tax. So all of these need to be put in through a proper system, a robust kind of a software, so you can manage things. Your finance team needs to be proper accountants. You can't just have anyone doing your accounts or managing your accounts, because at the end of the year, you need to make sure that the filing is being done properly. You're using the benefits that are allowed under the laws, the reductions, the adjustments that need to be made to the net accounting profits, and not just what you believe are supposed to be profits. Because there's also going to be an element where, for example, for single owner businesses, the regulations, when they come in place in later down the year, it might restrict the salaries of the single owner businesses. There might be that element, so you can't just book the whole profit as a salary and then be okay with it. So it depends on the regulations, but also it would depend on how you plan for your entity to run your business, and also make sure the things are being recorded properly, maintained properly, and you have proper records for whatever time period may be advised by or issued in the regulations. So it's really important to keep those things in check. And yeah, compliance obligations are always supposed to be understood properly. So having the right team is very important to get these things done or filed properly regarding any of these.
Nilesh, maybe a related question coming from Mark. It says, will accounts need to be finalized by an external chartered accountant, or is there a level at which internally produced accounts would be acceptable, not formally audited accounts?
Yeah, I think that's a very good question. I think we just given the experience we've had on ESR, where the requirement was if you were subject to an ESR report, then you needed to have accounts submitted along with the ESR reports. And the clarification was those do not necessarily have to be audited accounts. But obviously there was no tax payable under ESR. For corporate tax purposes, I mean, the issue clearly is that I think, I would expect the authorities to require accounts to be submitted certainly along with the tax return. The question is whether it's audited accounts or would management accounts suffice remains to be seen. Obviously, because there's a tax liability linked to the accounting profit, I would not be surprised if the authorities insist on audited accounts for every entity that is filing a tax return. I won't be surprised if that comes in.
Another interesting comment, it says, am I right in thinking salaries and dividends paid to shareholders for mainland companies is tax exempt? What would stop company directors paying themselves large salaries to drive profits to zero? I mean, this is something that is commonly done in.
I think, so clearly any salaries earned by individuals or directors and any directors' fees will not be subject to tax in the hands of the individuals unless, obviously for directors, unless they operate through their a company or if they operate through a trade license. But to the extent there is, excessive salary that companies may look to pay to their directors, I would imagine those excessive salaries to be blocked under the transfer pricing rules if those directors or shareholders are considered related parties. And therefore, any salaries or director fees may be paid. If they're related parties as well, then I would expect that to be on an arm's length basis based on, market comparable levels of compensation. So I don't think it's going to be as straightforward to increase salaries and expenses to get down to reduce the profits. There will be some, based on transfer pricing and some anti-avoidance rules, I would expect those, techniques to be somewhat blocked.
David is asking, and I think we have a very similar type of question across the chat today. It says, if a free zone trades into mainland and outside of the UAE, do we have to split income and expenditure so only mainland trade is taxed?
Again, a good question. So the presumption here is that if you have income from mainland and foreign business, that it's only the mainland income which is taxed and the foreign business is exempt. As I said in my presentation, that is still to be confirmed, whether it's a proportionate denial of exemption or whether the law will say that if you have any income from mainland, does that deny the exemption for the free zone company altogether? But in the event it's a pro rata denial of exemption, yes, to the extent you earn any exempt income, I would expect that any expenses that are related to the exempt income is not allowable as a deduction. So you will need to allocate the expenses. Obviously, the direct expenses are clear, but it's the indirect expenses that are allocable to both exempt and non-exempt income that I would expect that to be allocated based on cost allocation methodologies set out under the transfer pricing provisions.
Mm-hmm. We're getting a few questions related to freelance visas. There's been jurisdictions issuing freelancer visas. Would this fall under the regulation, freelancers?
Yeah, I think there's a specific FAQ on this from the Ministry of Finance. So I think if you have a freelance visa and therefore you need a freelance visa and a license therefore to do the business, to do the freelance business, if you earn income over 375,000 dirhams from the freelance activity, I think it says it will be subject to tax.
We haven't addressed the issue of offshore entities. We've talked about free zones and mainland. I'm guessing offshore falls under a similar structure than free zones.
Yeah, I think it says. I think the clarification says all UAE businesses earning income are taxed, and I think offshore companies, they're under an offshore regime, which means they don't require office space and employees, but it's still under a regime. They're still UAE companies, and they've been confirmed as being UAE companies for ESR purposes, for example. And I wouldn't be surprised I would expect offshore companies to also be part of the corporate tax regime.
Right.
Of course, to the extent these offshore companies are in free zones and earn all of their income from outside the UAE, then I would expect them to be exempt, but they may still need to register and file a corporate tax return.
Yeah. Excellent. Well, I'm conscious that we are a little bit over the time, and I'm sure you've got a few other commitments in the day. Maybe I'm going to ask my tech team. We have a landing page where anybody that would like to receive more information, feel free to, if our tech team can put this landing page, there is a form that you can fill in. You can ask us your questions, and our team headed by Zeeshan will be receiving these people connecting, and we will be happy to connect with you and answer those questions as much as we can. And also we will be engaging with Nilesh for those sort of bigger entities that would like to have more information on these topics. We're happy to also, since we have a collaboration agreement with Nilesh, we're happy to share this with him and with anybody getting in touch. So I think the tech team is putting already on the chat function this landing page. Maybe just to close for today, 30 seconds, Nilesh, what's sort of the main takeaways for today?
Yeah, I think the main takeaway is that, Lorenzo, is that while we don't have the law yet, I think there's enough information we have for businesses to already start assessing the impact of corporate tax. I don't think there is any, there's a lot of work that businesses can start doing already. Do engage your stakeholders about these developments. Do look at the impact of your systems, whether you will be able to extract the relevant data necessary to for corporate tax purposes. Look at your governance and controls already. Look at and alert your legal teams on this development, as any restructuring or reorganization that you may do, any transfer pricing policies you may put in place will require legal agreements to be drawn up or amended. And finally, model the impact of corporate tax into your profit, forecasts and cash flow models, because obviously that is something that until now we've not had to deal with in the region. So, the message really is, don't wait until the law is announced. You can already start preparing for corporate tax, given what we have in the announcements.
Excellent. Zeeshan, your final comments for today?
Similar to what Nilesh said, you need to every business needs to analyze and assess on the compliance obligations and need to really gear up towards this implementation of corporate tax, especially with the new year coming up, your financial years. You need to see how this becomes applicable to you and other obligations as well. This will be going hand in hand with the UAE being more transparent on a global tax regime system as well. So it really is something that everyone needs to look at and not have a more of a passive attitude. They need to be proactive in getting things done so they can be compliant well in advance and not be on a reactive approach as we saw previously.
Excellent. Well, Zeeshan, Nilesh, thank you so much for today. Nilesh, just one final thing I see. It's a very interesting question. Companies owned 100% by UAE nationals, taxed?
Not yet taxed, yeah. So unlike Saudi Arabia, Qatar, and Kuwait, which have a split method of taxation, I think that's a good question. So UAE is following the Oman model, which is that the tax is applied at the company level, regardless of who the owner of the company is, whether it's a GCC national or a foreign company. So good question.
Excellent.
I think it's a tax on the company regardless of the shareholding.
Excellent. Nilesh, thank you so much. Zeeshan, thank you so much for today. We appreciate your time and your expertise and this collaboration we have with you. Thank you so much for today.
Pleasure. Thank you.
Thank you, everybody. Good to see you all. We look forward to seeing you soon. All the best.
Thank you.
Bye-bye.